All right, Kevin, we're back for another weekly message.
When markets are volatile, we get a lot of questions. And so
Yeah,
we thought it would be a good idea just to answer some of these questions that we're
perfect.
hearing from people and, hopefully share information. That's what it's
That's
all about.
perfect. Information sharing. So I have a question,
Sure.
and it's about bonds. They're difficult. There's a lot of moving parts in bonds, believe it or not, but almost all of our clients own them. They're very important for our people near or in
Right.
retirement. They're down right now. It's been very strange time because interest rates are coming up, et cetera, et cetera. But explain to
Right.
us as simply as possible for me, Kevin, so if I can understand it, why, what's going on with bonds right now? What's the bright side, if any?
Yeah. Yeah. So, and that is something I've discussed with a number of people, Charlie. They've asked me about, hey, bonds are down this time, stocks are down. And, is there any bright side here? And I think the bright side comes from, and I like to use the story back when I was a kid. I used to hear old people like me now talking about what their CD rates were. So I don't know if you ever had those conversations going on around you, but I always noticed those kind of conversations when people bragged about what their CD rates were back in the 80s. So, the reason why you could brag about your CD rates was because there was inflation and interest rates went up. So when interest rates go up, that's what a lot of people have been telling you and I, Charlie, for years, and our team is
Hmm.
that, hey, there's negative interest rates, there's very low interest rates.
Yeah,
Well, be careful what you ask for because now
yeah.
we're getting higher interest rates. But let me show you first the photo that Betsy actually got for us. And it concerns this whole idea of how interest rates
Mm.
and bond prices work. And I'm not going to go deep, Charlie, don't
All right,
worry.
good. I'm still hanging
Uh,
on though. I'm still hanging
yeah,
on.
yeah. So, Charlie, if interest rates rise, okay, your bond is currently paying, let's say, 1%. Interest rates rise to 2. Well, all these new bonds are now paying 2. Guess what happens to your bond that's paying 1%? It goes down in value
The
to
price goes
equal.
down. Yeah.
Yeah, because it needs to equal that 2% that's now available in the market. So,
Mhm.
so what's happened with bond prices, and many of us, including me, think that part of the reason why stocks have gone down is because bond market has been so volatile. So bond prices have gone down. We're seeing, anywhere from a 6 to 11% decrease in bond prices. But the bright side of that, and that's not the bright side. The bright side is that yields go up. So, again, what's ending up happening now is many of these bonds that were paying 1%, half a percent, no percent, negative yields are actually now paying a higher interest payment. Now, why is that good, Charlie? Do you know why getting a higher interest payment is good going forward? Not looking back on what's just happened, but going forward.
Yeah, because that's money that that's real money that I receive in the form of interest, right?
That's right. That's right. And most of the time, people will say that the bond expected return of bonds is equal to their yield approximately. I mean, there can be capital gains and capital losses, what we're having right now. But so bonds are now finally paying something. So that's the part that I think is super good news. It doesn't really get out there because we're looking at our account balance. But Charlie, if you're in accumulation phase, you care about your wealth. Okay. So,
Hmm.
but when you're in retirement, what do you care about? You care about,
Income.
yeah, income, being able to afford, the next thing that you're going to buy, having cash available. And so I think this is pretty extraordinary that the yield has gone from last December. It seems like forever, December 31st, Charlie, 2021, but the yields were extremely low. So you see the 2-year bonds, the tips were negative, so they were paying a negative interest rate. Now, after the inflation adjustment, they were positive. So now we are getting much higher yields. So 2-year bonds, 2.7. Then the other part that's really interesting is as yields go up, everything goes up.
Hmm.
So the bond corporates are up now to 4.31, convertibles, and then high yield. So high yield was at barely over 4% last year. Now it's at 7.
Yeah.
So I think there might be, and I'm going to use the word what might because you and I don't know exactly what's going to happen in markets, but there might be opportunities here to now get higher payments, especially if you're in retirement.
Yeah.
The issue is, it's always about fear and greed, Charlie, as you
Yep.
know, and once you get to a point where people not just in the US, but around the world say, hey, I want that 3% interest
Yeah.
payment. I want
Yeah.
that 3.5% interest payment. And the UK just raised interest rates too. So now some of our foreign bonds we can actually get a return on as well. So eventually, we hope that the bond market will become more exciting to a lot of people around the
Yeah.
world and money will start to come into it. And then what will happen? Well, bond prices will actually go back up again
Mm.
when people start buying
Yeah.
into to get this interest. The
Yeah.
second issue is most of us think that, hey, inflation is going to be here forever. Interest rates are going to go up forever. Well, what happens if we do go into a recession and interest rates go back down, which they almost do every time in
Mhm.
a recession? Then guess what? Interest rates go back down, then this capital losses that you're seeing in your bonds will become capital gains. And
Mhm.
so I just don't think it's cut and dry. And I wouldn't just say, hey, I hate bonds, I don't want to own them. There are still some good reasons to own bonds.
Yep, absolutely. And it seems like even though our prices of bonds are down right now, that's a price, it's a temporary
Mhm.
price decline. But if we hold on to those bonds and don't sell them, then we avoid locking in that temporary price decline. And then the interest kind of helps make us whole a little bit over a while anyway. But our interest payments essentially are going to go up to offset some of that.
Yeah, I think it's always great to ask yourself what's going on going forward. If
Hmm.
you look in the rearview mirror, you say, hey, bonds are down between 6 and 11, 12%.
Hmm.
Oh my gosh. Well, now your expected return has actually gone up going forward, as
Hmm.
long as you're going to hold for a long period of time. Now,
Yeah.
you could wipe out all your interest in, a short period of time, and I get that. But the issue is, how do you know that interest rates are going to stay high and keep going higher? They may go down
Hmm.
as they have for the last 40 years, and why bonds had such a spectacular return sequence until this year.
Yep, that's right. And even Kevin, with the late 70s and early 80s of high inflation, high interest rates, the 30-year average was still 3 to 3.2%. And that's
Is that
typically,
right?
yeah, that's right. Even with
That's
that
good.
factored in, so
Mhm.
economists don't anticipate 5, 6, 7, 8% inflation for forever. So we're still, our planning numbers are still as good as they can be expected to be, and it factored in some high inflationary periods. Now, again, those are just projections and assumptions that we're using in our planning, but sometimes people say high inflation is here and it will, like you said, will forever be here, but that's not what's really anticipated by most economists anyway.
Yeah, I think so, Charlie. And then the other thing is that although we're people that invest money in stocks and bonds, we also offer the ability to get annuities through a partner. We don't get paid commissions, but even right now, the benefit of having these higher interest rates is that if you wanted to lock in today, let me pull it up here. If you wanted to lock in today and say, all right, look, I really do want guarantees. Bonds are not guaranteed returns. We know that, but you can actually lock in for 4 years and right now get about a 3.9% return, 3.8 with this other company. If you locked in
Hmm.
5 years, you can get a 4% return. These are truly guaranteed, Charlie. They're
Yeah.
just like a CD. Now there are surrenders. There's an illiquidity premium here, but you can get these. So if you're really
Hmm.
like, I can't stand this, I can't sleep. Well, annuities do make sense.
Yeah, absolutely. And like you said, we have a partner that we've teamed up with to help us help our clients. We don't get commissions for those. Because again, we're fee only. So, but we love that. I love that about our firm, Kevin, because we can recommend those when it's appropriate, and it might be appropriate now as these interest rates and these payouts start to increase.
That's right. Absolutely, Charlie.
Awesome. Well, awesome, Kevin. Thanks so much for that bond insight. Next time, we're going to talk about why does it feel like when I put in money in my 401k, my IRA, Kevin, it disappears? I put in money in my 401k, it's disappeared. Where did it go? We're going to talk about that. The short answer, the hint is the shares that I own have increased significantly. So we're going to talk about that next time. We're going to talk about how you can actually be profitable in a volatile market, what that math looks like. So
Yeah,
that's next.
Another Charlie Ellis used to always ask his students, and I think it was either Yale or Harvard. He used to say, "What do you want? The stock market to go down during your working years, or do you want it to go up?" And of course, the answer is down.
That's right. We'll show
But
you
we don't
why.
like that. We don't
Yep.
like that.
We'll show you the math. It's pretty
Yep,
convincing. Thanks,
absolutely.
Kevin.
All right, Charlie. Thank you.